We had a big sell-off on Wall Street here today with the S&P 500 down more than 2%. We actually saw the small cap universe, the Russell 2000, down 3.5%. Some of this was as a result of Dr. Fauci kind of giving some testimony and reminding us that there will be some risks involved with reopening our economy in the various states here in the U.S. We also heard some rather negative commentary from Boeing CEO that suggested that there may be an airline that goes out of business at some point this year. So all of that kind of set the tone for the sellers to come in and overwhelm the buyers here today. We actually sold off all the way into the close, which isn't usually a great sign either. So we could be in store for a bit more selling as this week develops. So we'll take a look at all of that, see how that affects our posture, if any, and then we'll get into our trade application example where I wanted to feature a bearish trade on an industry and a sector that's really been struggling here recently. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 12th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe. While you're over there, check out our description area where you can sign up for our email distribution list. We're also heavy users of Twitter. My handle is @BrandonVanZee. I would encourage you to follow me there. If you get value out of these daily Market Outlook posts, we would encourage you to click like and retweet there. I did notice the last time I did the video, I think we got 94 likes. Usually I'm trying to get up to that 100 level there. So we'll try to make tonight's video a little bit shorter as a result. Remember, if you want to kind of vote for me to have a more full-fledged 30-minute video, click like for me over on Twitter. If you'd prefer the shorter versions, then don't do anything there. Lastly, we do have a presence on Facebook as well. Feel free to check out our group at the web address embedded in the logo in front of you. All right, let's go ahead and jump into our charts. And as you can see, I've got chart 6D pulled up here in front of us. I usually like to bring this up whenever we have an outsized day, and today with a 2% sell-off was an outsized day. In fact, the VIX rose 5 points today, which is a pretty aggressive day for the VIX. VIX ended at about 33 here today, and that was good for about an 18% move. So there was a little bit more fear entering into the system here today, and that's finding its way into the options contracts as well. But as you can see, this 2% sell-off here gives us a rare opportunity to see a red bar dipping back down into the orange. That's the first time that's happened since the first day of the month here. Otherwise, since that time period, we've actually had more up days with these green bars exceeding that 1% level on a handful of those occasions. Today was a little bit of a give back there for the markets, and you can kind of see what that means for the S&P 500 up here as well, where we did end up having a bearish engulfing candle. In fact, we engulfed a couple of the prior day's candles in this case. And it seems like we're really kind of struggling to get up and through about 2950 on the S&P 500. And if we're not careful, we might end up looking back and seeing a bit of a double top here. We'll see where the rest of the week brings us. We don't want to get ahead of ourselves there, but it does seem like we stalled out a little bit here in terms of the momentum that we had once had rallying off the lows there on March 23rd. We had a nice shot in the arm to the upside, and in the last couple of weeks, it's kind of felt more like we're coasting sideways as opposed to continually going up. So we'll see where that brings us, but you know, obviously a lot of this depends upon government programs, stimulus packages, and you know how quickly we can get past coronavirus. And there's a lot of unknowns out there, so we've got to take it on a day-by-day basis. Let's go ahead and take a look at our next chart setup now. This one will be our traditional market forecast setup. And as you can see, there is a change to report here, and that is the Russell 2000. Russell 2000 now has a pink background color there. Reminder that means that we now have a bearish posture, in this case a weekly bearish posture, on the small cap Russell 2000 index. And the reason for that is the intermediate line is now at 76 and falling. So remember, if that's below 80 and it's falling, we would then consider that to be bearish. If it's below 50 and falling, it would be strongly bearish. In this case, since it's above 50 still, we just consider it weekly bearish. And we have to remember that we are still above a rising moving average. So there's kind of two competing thoughts there. The posture of the market forecast technical indicator suggests that we are bearish, but the 30-day moving average itself suggests that the path of least resistance continues to be to the upside. So we'll see once those two meet up in a battle which one ends up winning. Of course, it helps to have the support of the other indices at your back, and so far so good in that case. You can see here with the Dow Jones, the S&P 500, and the NASDAQ Composite, we still have green background colors there, suggesting that we still have strongly bullish postures on those indices, and all of them also are above a rising 30-day moving average. I should point out that we do have bullish intermediate confirmation signals on three of our indices here. So remember, that occurs when we have a green line that is considered bullish, and that can be either just by hanging out in the upper reversal zone above 80 or by traveling higher between 20 and 80. So that condition is met on all three of these charts. It's just barely there on the Dow Jones. You'll notice that that is at 81 and falling. If it falls below 80, it's no longer considered bullish. But as of this moment in time, we do have bullish postures, intermediate postures on all three of those indices, and then that's combined with a red line in the lower reversal zone on all three of those charts as well. Those two things together comprise a bullish intermediate confirmation signal. Here's the problem. The extreme nature of the red line is a concern with these setups. Traditionally, we want to see that the red line is above 5. So in other words, we'd like it to be below 20, but above 5. If it's below 5, then that's a pretty extreme sell-off, and it might give us an indication that the bears are becoming a little bit more emboldened. So it is a true signal. It's just not what we would deem an ideal signal. You guys have heard me talk about that concept in the past. Usually when I'm having that conversation, it's in regards to where is the blue line in all of this. And actually where the blue line stands with all three of those indices is actually in pretty good shape. We like the blue line to be between 50 and 20 on those bullish intermediate confirmation signals. So right now the fly in the ointment is the extreme nature of the red line. All right, let's go ahead and quickly take a look here at our three green arrows setup. And on this particular chart, it's going to be chart 4D for those of you that are premium members following along at home. And as it stands right now, there's only one man remaining, or one woman remaining here, last man standing, however you want to say that, and that is the NASDAQ Composite. NASDAQ Composite continues to have a three green arrows signal. All of the other three charts have seen those signals removed. In the case of the Russell 2000, it was just today. As you can see, it received red arrows on both the MACD histogram and a phantom red arrow on the stochastic. So right now, the only one that's hanging on for dear life is that NASDAQ Composite, which of course, as we've been talking about for weeks at this point, has clearly been the leader of this market with so many tech stocks holding up better than others. In terms of some 12 grid analysis, let's go over here to chart 5A, and this will be our asset class 12 grid. Try to get a sense of what's happening outside of the stock market here. Down in the lower left, you'll see the US dollar has been firming up here more recently and now has a strongly bullish posture. That's somewhat new because remember, we only get a strongly bullish posture if the intermediate line is above 50 and rising. In this case, it's at 51 and rising. So in other words, it's just barely a strongly bullish posture. But nonetheless, it is a change worth pointing out there for those of you that are following along at home. Also, you'll notice that foreign bonds had a little bit of a tick higher here today. They are actually in the upper reversal zone there for the intermediate line. So that's been one of the stronger trends out there more recently. You actually don't find that trend in existence quite as well over here on the U.S. government treasuries, long-term treasuries at least. You can see that TLT was up 1% today, which is a pretty strong move for it. However, the moving average color is red here. Notice the difference between that and the foreign bonds. Foreign bonds have this green moving average telling us prices above a rising moving average. In the case of TLT, we're actually prices below a falling moving average. So got a little bit of work to do. Obviously, if the stock market is to fall and fear enters back into the system here in coming sessions, it is possible that is a fertile environment for treasury bonds, as usually that is viewed as a bastion of safety when there's a lot of chaos around you in the financial markets. You can see here that gold does have a weekly bearish posture right now. The intermediate line is at 73 and falling. However, I'm not willing to write this trend off yet. You can see that we've really just been consolidating sideways here for the last month or so on gold, but that entire time period has been above that rising moving average. So I'm still somewhat optimistic we might be able to catch a bit of a bounce here in the gold trade here going forward. Worth noting from a foreign stock perspective is up above here on EFA. Now remember, EFA is your developed foreign markets. Those are going to be countries in Europe, Japan, Australia. Those areas are now considered to be weekly bearish according to this chart. The intermediate line is at 76 and falling. So again, it's above a rising moving average, so we're not going to completely write it off, but you can tell that that is lagging the US market and then also emerging foreign stocks. So right now the place that is a little bit more difficult is the developed foreign stocks, at least in US dollar terms. In terms of our next chart, let's go ahead and take a look at our US sectors 12 grid. This will be chart 5C. And so as you can see here, we now have just as much red on the board as green. And one of the areas that's really struggling, and it's a little bit confounding, is the financials. With the market as robust as it's been in the last month or two since the bottom in mid-March, you would think that the banks would participate a lot more than they have, but that is just simply not the case. Wells Fargo hit a new 52-week low here today, and many of the other major banks aren't that far behind. And remember, they represent a major portion of our market. So in order for the entire stock market to take off like a rocket, I think you kind of need, those that grease the wheels of capitalism, the banks, to participate. And right now, they're just simply not. So that's a bit of a concern. Then you also have industrials. Mentioned Boeing coming out with some negative words and commentary about airline industry here today. So that's affecting the industrials. Materials struggling on a little bit there. And then on the bottom rung, staples, utilities, and real estate. And we saw a lot of those trends take shape in my sector selector that we discussed in my Monday top-down trend trading class as well. In fact, utilities have performed so poorly that they now have a strongly bearish posture yet again, and real estate isn't all that far behind. You can see real estate was down 4% here today. That was ugly. There's a lot of real estate companies that are cutting their dividends. I would expect more to come as a result of many businesses and citizens just not paying their rent, whether it's commercial real estate or whether it's to your local apartment. There's just not as much motivation to pay rent right now in this coronavirus world that we're living in. And a lot of those real estate investment trusts are suffering as a result because they're usually viewed as kind of a pass-through security where investors are interested in them for their cash flows they produce. But if they're not receiving cash flows, they're going to have a hard time passing that through to their investors. So they're starting to struggle a little bit more there, which does give us a nice segue into our trade application example here for today. So for this, I wanted to come on over here to our swing trading chart 3A, and I'm going to pull up ticker symbol ESS. This is Essex Property Trust. This is a residential real estate play here. And you can see that they have underperformed the S&P 500 with this dotted line right here over the last 3 months. You can see they've already reported their earnings, so we don't have any sort of landmine in front of us from that particular perspective. And you can see that as of the last couple of days, they've really been selling off and now have a bearish near-term posture, which is this blue line down below. But you can also see that the green line has rolled over here in the last couple of days as well. So you have a bearish intermediate posture and a bearish near-term posture. You can also see with today's move lower, we crossed below that 30-day moving average. And you can also see that this is the lowest price this particular security has traded at since this candle back here in the first week of April. So whereas a lot of the rest of the market is still closer to its highs over that time period, this is one of those real estate stocks that has struggled over that time period. So what I thought we would do here today is put on a bearish swing trade where we would short sell this particular security, which means you would have to do it in a margin account. Of course, we're just doing it here from a paper money purpose, but you can't short sell stocks in retirement accounts, so you might have to look towards the options market if you wanted to follow along there. Nonetheless, it provides at least an opportunity for us to take a bearish trade, since we've been kind of placing a little bit more bullish trades here more recently, and we've got to stay sharp on the bearish side of the coin as well. So what I'm going to do in this case is I'm going to put our stop loss a couple of pennies above the high of this candle right here, and the high of that candle was 262.23, so I'm going to put my stop loss at 262.25. I'm going to try to get filled tomorrow morning at this price that it traded at and closed at here today, which is 229.90. And if I got my calculator out there and took those two numbers and subtracted them, so 262.25 as our upside stop loss minus 229.90 means that we're going to have $32.35 worth of risk per share on this trade. And if we wanted a 1-for-1 reward risk ratio, what I could then do is subtract out 229.90, which is again the closing price as of tonight, and that means that our price target in this bearish trades case would be 197.55, and you can see 197.55 would be around this area. So it'd have to kind of start going back towards these candles that you see back here at the end of March. If it can get there, we would take our profits. If it does go up above this candle over here, we would get stopped out at a loss. So let's go ahead and place that trade. I'm going to right click on the chart. I'm going to go over here to sell custom with OCO bracket. So we'll do one cancels other order. I'm going to clip that little paper clip icon together. I'm going to do 100 shares here for this size of an account, but remember, that's just your default status. You're of course going to want to change the amount of shares to fit your own personal position sizing there. In terms of where do I want to sell this, as I mentioned before, I'll just try to sell it at where it closed here today, which is 229.90. I'm just going to leave that in as a day order, so if we get filled tomorrow, great. If not, it'll expire. In terms of our downside price target, which is the first line in green there, that's 197.55. I'm going to put that in as a good till cancel order. Directly below that, we're going to change that to good till cancel as well. And then our stop price, remember that's going to be the higher number here because this is a bearish trade. So there we're going to put in 262.25, 2 pennies higher than that candle back there. All right, so let's go ahead and click confirm and send, and we'll ship that off and see if we can get filled first thing in the morning. All right, well, thank you for joining me here yet again. Remember, if you get value out of these nightly videos that you receive for free on YouTube, how you can thank us for that is by going over to Twitter and clicking like for us there. I'll have this posted to the top of my timeline to make it nice and easy for you. If those of you that are out there in Twitter sphere want a more extended video the next time around, let's try to get that up over 100. If you prefer these kind of slimmed down versions here of under 20 minutes, then don't click like, and we can kind of do more of these shorter videos as well. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.